Have you ever wondered why interest rates change and they affect your daily life? Today we're breaking down the concept of interest rates, why they matter, and how they affect you. What exactly are interest rates? An interest rate is the cost of borrowing money or the return on investment for savings. If you take out a loan, the interest rate is the extra amount you pay back the lender on top of what you borrowed. If you save money, the bank pays you interest to keep your money with them. So who actually decides these interest rates? In the US, the main player is the Federal Reserve, often called the Fed. Now, the Fed doesn't directly set interest rates, but it influences them through something called the federal funds rate. This is the rate at which banks lend each other money overnight. When the Fed changes the federal funds rate, it indirectly affects other interest rates in the economy, like the rates on mortgages, car loans, and savings accounts. The Fed adjusts interest rates mainly to manage economic growth and control inflation. When the economy is slowing down, the Fed may lower interest rates to make borrowing cheaper, encouraging people to spend and save more. On the other hand, if inflation is rising and prices are getting too high, the Fed may raise interest rates because higher rates make borrowing more expensive, which will slow down the spending and help cool inflation. This is one of the Fed's mechanisms in which they try to influence and control the economy. So what do interest rates mean for the average person? Let's break down a few key areas. 1. Borrowing costs. When interest rates are low, it's cheaper to borrow. That means lower monthly payments on loans like mortgages and car loans. When rates go up, borrowing costs rise, and those monthly payments get more expensive. 2. Savings and investments. Interest rates also affect how much you earn on savings. When rates are higher, banks typically offer better returns on savings accounts and CDs. Lower rates, however, mean that money in your bank grows more slowly. Number 3, inflation and purchasing power, which is the very important one, because finally, interest rates are tied directly to inflation. If rates stay too low for too long, it can lead to high inflation, where the cost of goods and services quickly rise, meaning your money doesn't go as far. Now, here are some tips for managing finances in changing rate environments. Interest rates can go up and down depending on the economy, so it's important to be prepared. Here are a few tips for managing your finances during different interest rate environments. Pay down high interest debt. This is a no-brainer. If interest rates are rising, it can be a good idea to pay off your high interest debt, like credit cards, as quickly as possible. Build an emergency fund. A solid emergency fund can help you weather periods of economic uncertainty, especially when borrowing becomes more expensive, because it always does. Consider fixed rate loans. If you're planning to borrow, a fixed rate loan can protect you from rising interest rates in the future. Interest rates may seem like a small piece of the economic puzzle, but they have a huge impact on everything, from your personal finances to the overall economy. But understanding how they work, you're better equipped to make smart financial decisions, no matter what the economy throws at you. Thank you for watching. Don't forget to like, subscribe, and share if you found this video helpful. Stay tuned for more insights on how the economy affects your everyday life.